Hey, I'm Abe, and today we're going to talk about a personal experience. This is going to be more of a cautionary tale about investing in one stock, thinking that it's a great idea, and then seeing what that does over time. I had summer jobs in high school. They were basic filing and alphabetizing jobs. I didn't make a lot of money. I was making minimum wage. I went to college. I had a couple summer jobs, made a little bit of money there as well. Again, nothing great, but enough so that when I got out of college, I had saved a little bit of money. Obviously, I was young and stupid, and so I had spent a lot of it. But I had saved a little bit of money, and I decided that I was going to put it into a Roth IRA. I was going to invest it and then, I don't know, figure something out from there. So I didn't do a lot of research. The jobs that I'd worked on campus when I was in college were IT jobs. So I was working around networking equipment. I was dorm or campus IT essentially. So I felt like I had a pretty good grasp on that field. I'm looking around, I'm seeing all the equipment we're using is Cisco equipment. I thought the internet was going to be a big thing, and I thought everyone was going to need networking equipment and, networked telephones and all kinds of things. All of this stuff that I saw Cisco making, they were the only name I was aware of. So I thought Cisco would be a great investment. So I put $2,000 into Cisco. That's it. Just Cisco, nothing else. So let's take a look. And this was somewhere around the beginning of 2002, end of 2001. I had a little bit of money. I put $2,000 in, somewhere around $20 a share, right? And if you're looking ahead, you can see that after 10 years, I worked in retail. I didn't have a lot of money. I wasn't really paying attention to what my one investment had done. So I wasn't tracking this. I just knew I had invested in Cisco, and of course that was an intelligent move, right? Because I was in the industry. I knew what I was doing. I was in this, basically tax-free account. So I was just going to make all kinds of money. I had heard of Netscape employees when Netscape went big. Even just receptionists were millionaires because of what few stocks they had and how much it appreciated over time. So my Cisco stock, I'm working at Circuit City, also around, networking technology, and I should have been paying attention, although I'm not sure I would have noticed anything. And the stock is not doing much. If anything, there was a little bit of a spike here in 2008, and then it comes back down, and now we're at a low in 2009, which you can understand, but we're talking like 33 down to 15 or so, and then, just kind of back up and down. So now, in this time, I have worked at, I waited tables, I worked at Circuit City, I sold shoes. I decided that I didn't like selling shoes or working in retail, so I decided I was going to put myself back through school for a second bachelor's degree in engineering. All of this time, Cisco, I'm just letting it ride. I get an engineering job, I start to make a better living than I was previously, and now I've got a little bit more money, and I start to think about maybe going to business school. And what does that make me think about? Investing and saving money. So, let's see. So somewhere around 2012, I'm like, let's reassess where I've put my money. $2,000 in Cisco, I open up my investment account, I look, and after 10 years, still $2,000. That it had gone on this roller coaster ride without me paying attention for 10 years, and I should have, as if you're remembering the compounding interest example, you'll remember that I could have made a significant amount of money here. And if you remember specifically, over 10 years with an initial investment, you could get almost 80% return on your money if you had just invested in the market. But you look at what I did here. So instead of $3,600, which would have been an 80% growth on 2000, I got and secured for myself a 0% growth over 10 years, which is bad. Now, could I have lost money? Yeah, I could have lost money. It could have been worse. But the story here is I chose an investment I thought I was educated to make in a specific company. And then I was, regardless of what the rest of the market did, I was beholden to this company's performance. So another thing to note, and if we come in here and we just look at the max interval. So all the way back to the beginning, you're looking at somewhere around 1990, and then it starts climbing, right? And right around here is the dot-com boom. I decided in my infinite wisdom to invest here, somewhere around in here. And then 10 years later, it was back somewhere around over here, I think. You can see then that I hadn't looked back and seen that there had been a spike and a big plunge. I didn't research what that plunge was all about. I didn't see or know really much about Cisco at all. It was an ill-advised decision. So, what's the takeaway here? The takeaway is that diversification is important. And I just wanted to give you a real-life example from my personal life that you're going to make mistakes. Hopefully they will not be crippling mistakes, but I made a mistake. Hopefully you can learn from my mistake and not do the same thing. So investing in individual companies is very risky. Investing in general is a somewhat risky endeavor, but you can mitigate or reduce a lot of that risk with diversification in investing in a lot of different companies or just in the market as a whole. Venture capitalists and folks that invest in extremely risky businesses like startups do this as well. They have done the math. They know that literally 1 in 20 or maybe 5% of startups will be successful. And so they have a portfolio of companies that they've invested in that is broad, so that if all of their tech startups really take a dump, they've got other startups. So everybody is doing this. They are all looking at their investments. They're not putting everything in one basket. And they're definitely not, and you should definitely not, consider only one company as your investment, especially if it's the company you work for. You might be drinking the Kool-Aid. You might think that your company is the best. You might be investing your retirement savings in that company because, like our parents and their parents before them, that was the sort of loyalty that you showed, is you invested in the company that you worked for. They were like your family. And as they succeeded, you succeeded. That methodology or that philosophy, my first job as an engineer was working in the defense industry. When I started and when I got hired there were 22 to 2,400 people in my location in the Bay Area. They were hiring people as fast as they could. Within 2 years, they had gone from 22 to 2,400 employees in this area to 600 to 800. And then another 2 years later, they were down to 200 to 300. All of these people who had lived at that company, who'd worked there for 20 or 30 years, this was their source of income. They had invested their money in the company in stock. When the company did poorly, they got laid off, they lost their income, and all their stock became worth a lot less. And as a result, not just one aspect of their well-being was severely impacted, but both or all, essentially. Obviously, their houses didn't lose value, but because of the way 2008 played out, that's when around that happened. So 2008 to 2010, 2010 to 2012, those people lost 40+% of their retirement. They lost their income and were forced to retire early. And then looking for work at the age of 55, 60, 65, 80. We had people there who had come back to work after the big recession and like in their 80s, and they were being laid off. So this is a warning and something that you should be aware of. Don't invest too heavily in the company that you're working for or wherever your income is coming from. Try to keep those separate. And think about the industry of the company that you're working for as well. That if you are working in the tech industry, you may want to leverage and have your investment exposure in other industries so that if you lose your job, you will still have your investments doing okay. And if you lose your investments, your job will still be okay. So that there's a bit of a counterbalance. Next week, we're going to get into mutual funds and exchange traded funds. But I thought it would be important and interesting to see a flash of somebody's personal experience in investing at their first foray, knowing very little. See some of the mistakes that I made and hopefully that you won't make. And we can all continue to learn from each other's mistakes. So hit me up in the comments. Tell me what mistakes you've made. Help other people, help me, and we'll grow and learn together. Thanks for watching, and I'll catch you next week.